right, my friends, we're now going to jump into consolidation concept. Now, in this area, let's start with the fundamentals. You've got one company that's legally set up and incorporated, and they have owners. You have a separate company, a whole different company that was owned by their owners, two independent companies. But now one of them, the parent, is going to buy the shares of the subsidiary. So now they own their own parent company and they also own the subsidiary. So while they're still legally two separate entities, for accounting purposes, we go substance over form. They're really one giant company. It's you have one pocket where you have assets and liabilities, but you have another pocket where you have assets and liabilities. They're both under your control, both pockets. So we put all the assets, we take all the liabilities, we take all the equity, we take all of the income, and we show it as a combined company. So this is all about voting interest. So this is your voting interest model where you own more than 50% of the other company. And the real criteria is the control. And control is not exactly 50%. That's a joint venture. That's a partnership, 50-50. It's when you own more than 50%. Now, what happens when you own less? Well, traditionally, we have the 1% up to the 20%, and that would be the fair value method, where you would literally record the items at fair value each period, and you would adjust that fair value either. If it was a trading stock, you would run it through income. If it was an available for sale stock, you would run it through OCI, other comprehensive income, under the ASC topics. Notice, if you own more than 20, typically we actually use the criteria. You have the ability to exercise significant influence. Now, notice it's not control, it's significant influence. Even right up to 50%, it's significant influence. Then we use the equity method, which we've covered in prior programs as well. Once you own over 50%, it can be 50.5, you're now in control, and you consolidate, and we use the acquisition method. That will be proper here. So we consolidate when we control the company, which is greater than 50%, unless doubts exist regarding your ability to control. And that would be when you're in legal reorg, right? The courts are handling it. Or you're in bankruptcy. Once again, the courts are handling it. Or maybe there's severe foreign restrictions, and therefore you're not able to actually make decisions in the lanes that you want to. So hence, those would be some of the fundamental exceptions to the rule. So we're going to show you some graphics here. You have two legally separate companies, a parent company and another company. We decide that what we're going to do is we're going to target the subsidiary. We're going to buy their shares and we're going to give them cash. Now, we may ultimately decide not to give them cash. We may give them our stock. If we give them our stock, it's the fair value of our stock, right? So technically, it's the fair value of the cash, which of course is the amount of cash, or the fair value of the stock we've surrendered. So either type of transaction, cash for their stock or our stock for their stock. Note what happens afterwards is you now own more than 50%. So therefore, we own the parent owns the subsidiary. So really it's we control both, substance over form. So you consolidate the sub and you consolidate 100% of their assets, 100% of their liabilities, etc., at fair value on the acquisition date. Even if you only own 80, 85, 90% of the company, you may have what we call a non-controlling interest, formerly referred to as a minority interest, but now we refer to it as a non-controlling. Somebody else owns a small piece of the company. So let's take a look at that non-controlling interest. That's when you own over 50%, but you don't own 100. You may own 80 and they own 20. You're in control, but you have to reflect their percentage ownership in the assets. Because think of it as you're buying their company. It has one asset, $1 million building. You paid $800,000 to buy 80% of that $1 million building. And at this point, you're going to show 100% of that building on your books. You're going to show $1 million building, even though you only paid $800,000 for an 80%. So you're going to show the building at $1 million. You obviously surrendered cash of $800,000. And then, of course, the other party owns another $200,000 of it. That's how you'll be setting this up. So once you have the controlling interest, you consolidate. But if you don't own 100%, then you're going to have to show a non-controlling interest. And it's the portion of the assets. Remember, you're going to record them at 100%, but it's that percentage that you just showed on your asset side that you don't actually control. That 20% or 10% or whatever it happens to be. That will be the element known as non-controlling interest. All right, with that, we're ready to now move on to our next feature.